All right, everybody, welcome to Truth in Accounting's Ask the Experts webinar. Thanks to the Union League Club of Chicago also for co-sponsoring. Today's topic is President Biden's infrastructure plan and its relationship with America's largest cities. My name is Bill Bergman. I'm the Director of Research with Truth in Accounting. We're a nonprofit dedicated to helping citizens understand their government and its finances with a view to promoting truthful financial reporting. You can learn more about us at our website. You can also sign up for our morning call newsletter, where we compile our government financial news every day. We also offer something called our Data Z website, which is a compilation of demographic, financial, and economic factors, and you can use it to compare your local area to your neighbors or elsewhere in the United States on a wide variety of financial, economic, and demographic factors, including the debt of your state and local governments. Today's event dovetails with Truth in Accounting's new report on the 10 largest U.S. cities. We call it the City Combined Taxpayer Burden Report. The report, what does it do? It analyzes the debt of the city governments, but along with the underlying or related entities, including counties, school districts, and transit authorities. When all this debt is combined with the state debt, the city taxpayers are on a lot more hook for debt than what mattered for instance, just their city alone. We'll get more into this report later. We're honored today, most importantly, to have Steve Malanga as one of our experts. Steve's the George Yeager Fellow at the Manhattan Institute. He's also City Journal, a very interesting publication I'm starting to look up daily lately, the senior editor of City Journal. He writes about the intersection of urban economies, business communities, and public policy. Steve's authored a number of books and publications for the Wall Street Journal, the New York Times, Los Angeles Times, and more. Before joining City Journal, Malanga was an executive editor of Crane's New York Business, serving on the publication's editorial board and writing a weekly column. Joining Steve and I today is Truth in Accounting's founder and CEO, Sheila Weinberg. Sheila's a CPA and has led Truth in Accounting's initiative since she founded the organization in 2002. Her commentary on federal and state and local government finances and budgeting issues has appeared in numerous publications, including USA Today, the Washington Post, and the Wall Street Journal. For today's event, everyone's going to have a chance to ask a question via the Q&A feature at the bottom of the Zoom screen you're looking at. If you look towards the bottom of the screen and hover your mouse, you'll see a panel with Q&A. Just type your question in that box anytime during the event, and we'll try to answer it. I'm going to turn it over now to Sheila and then to Steve for comments, and then we'll get to the questions. Sheila?
Thanks a lot, Bill. Yeah, Biden has proposed theoretically an infrastructure bill. Now, that's what the media is calling it, but the Biden administration actually calls it the America Jobs Plan. It's about $2 trillion is what they're proposing to spend. So obviously you can include a lot of things, infrastructure and other things in a $2 trillion bill. I'm just going to highlight a few things that relate to the cities and other governments. The bill proposes to shore up the existing Amtrak line. You'll remember the president used to take that line from his home state to Washington, D.C. So he's very familiar with that line. And that'll affect the cities mostly in the Northeast corridor. The bill also provides the cities and states for enlarging their broadband networks. He thinks that will improve people being able to access the internet throughout the country. It also establishes grants and incentives for cities and other governments to build a national network for electric vehicle chargers. So as people are buying more electric cars, which is what they hope, they'll be able to charge them not just at their home. It also calls for replacing many city school bus fleets with electric vehicles and other city bus vehicles with electric vehicles. And then there are thousands of little, large and small infrastructure projects at the city and state level. Charles Marin from Strongtown believes, quote, "It's unfathomable that we should build another lane of highway, another bridge, another overpass, or any other infrastructure system when there is a profligate," is that how I say it, Bill? I forgot how to say that word.
Profligate.
Well, there's a lot of infrastructure spending, but the bill in that bill, but it doesn't even tackle more than 20% of the backlog of the existing road maintenance. He points out, and I quote, cities need lower costs because they're insolvent, because they can't afford to maintain all the streets they have already been induced to build. He stresses that instead of throwing more money at infrastructure, including which would include long-term maintenance costs for the cities, we need to do a cost and benefit analysis. Will the cities have enough money to even maintain all these projects that the Jobs Act bill is suggesting? And at our study, since you mentioned insolvency, in our studies, we have found that the cities don't have enough money to maintain their current maintenance, much less add more. Our financial state of the cities, in which we reviewed the 75 most populated cities, found that the unfunded debt of the cities amount to more than $350 billion. And if you define insolvency as the inability to pay your debt that you already owe, more than 62 cities are already insolvent. The study that we're releasing now, that financial state of the cities, reported New York City with the highest taxpayer burden, with the city of Chicago second. In our studies, what we mean by taxpayer burden is each taxpayer's share of the governmental entity's debt. But then what we found, interestingly, in our 75 most populated cities study, was that while New York City's financial report included the city and county's debt, governments like the city of Chicago didn't. So we went ahead and, as Bill mentioned, we released a city combined taxpayer burden, where we take the 10 most populated cities and include their underlying governments. To give you an example, the city of Chicago's financial report only includes the corporation of the city of Chicago. It doesn't include the Chicago Public Schools. It doesn't include the Water Reclamation District, the Park District, the county. And if you add all of those underlying governments' debt taxpayer burden to the city's taxpayer burden, you come up with more than $126,000 that each taxpayer in Chicago is on the hook to pay for this past cost that's already been incurred, but they're going to have to pay future taxes to cover it. So in that study, if you study it that way, Chicago actually comes out as the worst city with $126,600 per taxpayer being on the hook. New York City is our second worst city, and the other 10 most populated cities we include in that study is Los Angeles, Philadelphia, San Jose, San Diego, Dallas, Houston, San Antonio, and Phoenix. You can find this report at our truthandaccounting.org website. And if you want to look up those individual cities reports, you can go to our Day to Z website and go to that city. So for example, go to San Diego's page and scroll down to the city combined taxpayer burden. But for now, again, Steve, thank you so much for joining us, and we'll talk more about this fun debt as we go along.
Yes, so thanks, Sheila. So I want to follow up on this idea of infrastructure, and particularly basic infrastructure versus this expansion of infrastructure. And as background, what I want to do is talk a little bit more about the fiscal state of cities, because one of the reasons that cities are having trouble even funding something as basic as maintenance or basic infrastructure, which people kind of approve of basic infrastructure, roads, bridges, mass transit, new schools, those things are fairly popular. But what's happening is there's a crowding out going on because cities have not actually been able to adequately tackle and reform their spending, particularly their long-term spending on things like retirement benefits and other sorts of things like that. And as a result, what we're seeing is what's called a crowding out increasingly of basic spending, because especially because of growing debt. And before the pandemic actually started, I was thinking of writing a long report similar to this top 75 cities and their debt that you produced, which, by the way, we should say that's based on data from before the pandemic. And the reason I was because cities in the 2008 recession had used a lot of questionable financing schemes, if you will, to balance their budgets in that recession because they were very unprepared for that recession. And they were also, and they remain very much resistant to reforms, political reforms. Mayors and council people are worried about getting unelected because they, reform, like let's say employee benefits, and public sector unions have a lot of power these days. But because of that, what had happened is we had a 10-year economic expansion. And yet after 10 years, the state of cities in 2018 and 19 was not very good. Debt had continued going up and up and up. More and more of the spending was spending on debt service and spending for increasing pension costs, which they were being forced to pay, all of which, as you know, is for things that they have work that's been done previously, but we're now having future generations pay for this. When the pandemic hit, that kind of, the cities all began, and states too, and all forms of government, schools began essentially saying, this is unprecedented. We need special help from the federal government. And I found it hard at that particular point to stand up and say, look, yes, the pandemic is unprecedented, it's a problem, but it's also true that because of their budgeting practices, states, and particularly cities, were unprepared for any kind of recession. As time has gone by, and particularly as we're starting to recover and come out of this, more and more that's becoming clear. And I think your particular study of the top 75 cities is interesting for this. Essentially what happened is cities squandered the recovery. They didn't put money away. They didn't grow money on basics. Instead, what they did was they didn't fix those schemes and techniques that they had used. They didn't take money that was coming in from improved tax revenues and use it, for instance, to pay down debt or to grow their reserves. They used it essentially to expand. They didn't reform their pension systems. They didn't reform their benefits. As a result of that, they weren't in a good position to start off with as soon as this recession started. What they've now done is essentially similar to what they did in 2008. They've used the pandemic as a reason to increase this kind of bad budgeting, therefore digging further holes for themselves and guaranteeing that there will be more crowd out of essential spending, like spending on infrastructure. I'm going to give you just a couple of examples. A research group called the Municipal Market Advisors did a study in the second half of 2020 of municipal bond issues. They looked at more than 400 municipal bond issues. More than a quarter of these municipal bond issues were for deficit financing. Now, if you're from Chicago, this is often called scoop and toss financing, and people in Chicago kind of understand what that is. Basically, what it is using debt to pay your everyday expenses, which in many states is actually supposed to be illegal, if you will. It was often justified by the pandemic, but a quarter of these financings were essentially direct deficit financing. And in addition to that, states and cities, particularly cities, made record use of pension obligation bonds. Now, this is basically, you go out and you borrow money to put into your pension system, and then you say, since now the pension system looks better, that, well, we borrowed this money at 3 to 4%. And we're going to invest it in our pension system and get 7% back. Now, if that doesn't strike you as dicey and extremely risky, just imagine, for instance, going to the pension advisor that your company's 401k has and saying, listen, I got this great idea. What I'm going to do is I'm going to borrow money against my house, a home equity loan, because the rates are great. And then I'm going to put it in my 401k plan. If your pension advisor didn't say that's crazy, you could probably sue him for not following his fiduciary responsibilities. But that's what cities are doing. And the reason, first of all, the Government Financial Officers Association around America has warned cities and states not to do this. And one of the big reasons they warn people is because, of course, you can not only not get a return of, let's say, 6 or 7%, right? You could actually wind up owing money, but you could actually lose your principal. In fact, these kinds of pension obligation bonds were behind some of the biggest bankruptcies after the last recession, including Stockton, California, which had borrowed $125 million, gave it to CalPERS in 2007, and CalPERS promptly lost a quarter of the principal, and also behind the Detroit bankruptcy. What's also going on, however, is that what cities have done in the last 6 to 8 months is they have used increasingly questionable techniques which attempt essentially to skirt actual law. So most states, for instance, say that you can't just go out and borrow money if you're a government. You have to either ask the voters to borrow money, or there are caps in many states based on the size of a city. Cities are doing all kinds of things to get around that, to put on new debt. So in Arizona, for instance, places like Tucson and Phoenix, they have borrowed money using something called certificates of participation. What does that mean? Here's what it means. What you do is you sell your infrastructure to yourself. Okay, you sell your city hall, you sell your roads, you sell maybe any other government office buildings. If you own a hospital, you sell that to yourself. You put it in a shell corporation. After you put it in a shell corporation, you then agree to rent and send rent to this shell corporation. The shell corporation then uses the promise of rent to borrow money from investors and give that money to the city. But this is all called not borrowing, it's called rent. And so Phoenix did like a $600 million pension obligation bond offering, but they did it through certificates of participation. Now, this was what Detroit had done in 2004, 5, and 6 to allow them to circumvent Michigan law. And it was one of the things that the financial manager that was brought in to try to work out and get Detroit out of financial trouble finally looked at and said, no, we have to put the city into bankruptcy. So these are the kinds of maneuvers that are going on now. Cities selling their infrastructure to themselves, right? Not legitimately selling them to raise money, but selling them to themselves so that they can borrow money and call the proceeds, sales, and then say they're paying rent back for all this. So if you look at this kind of situation, the prospect for cities themselves being able to finance their basic infrastructure in the future becomes more and more risky, because what we see is more and more crowding out. If you look at places that did these deficit financings, if you look at their balance sheets or these pension obligation bonds, over and over again, when I look at them, what I see is in the last 10 years, their pension costs have doubled and tripled. Their costs for debt service in general has gone through the roof. And so more and more of their budgets are actually going to pay back borrowing or costs that have been incurred in the past, which leaves you much less money to do things like build or even maintain your own infrastructure. So this is this kind of background to what we see right now. And from here, we have the Biden administration doing two things: sending huge amounts of money to the cities and states, but trying to restrict how they can spend it, and then trying to redefine infrastructure at the same time, which creates a whole bunch of new set of programs that cities themselves wind up inheriting. So this is kind of the overview, I think, from which we're starting in this discussion.
And Steve, you mentioned, this unprecedented pandemic and this unprecedented crisis, which, this is a crisis to the magnitude that we haven't experienced in a long time. But you also mentioned, the housing market crisis, and then there was the banking crisis. It seems that we have a crisis every 7 years. So
if you actually look at the language that was used in 2007 and 2008 and the language used today, and the language that was used, actually, remember, the recession of 2000 and 2001, which actually extended to 2002, was also eventually wrapped into 9/11. What you're saying is exactly true. Every recession now I guarantee you, cities and states are going to ask for special stimulus money for every recession. And it's whether they get it or not, I think winds up depending upon who's in office, who's in Washington right now. The Obama administration gave, what I thought was significant amounts of money, especially to schools back then, to basically keep paying teachers. Ironically, in the long term, it didn't help, because after the money disappeared, okay, because the cities and states and schools weren't using sustainable budgeting practices, after the money disappeared in 2010, 2011, 2012, they were still cutting jobs while the private sector economy was recovering. Okay, so we are in this pattern now where I guarantee you, with every recession, cities are going to find a reason to say, you need to bail us out to Washington.
Well, maybe, these cities and states have balanced budget requirements. I'm actually starting, which I think is a good thing if they really did the accounting right and they didn't borrow money to, quote, balance the budget. But I'm actually starting to think that maybe instead of actually balancing the budget, we should shoot even higher. They should start running either reserves, or they should be required to have a plan to pay down the debt. Because if they just balance their budget every year, then they can't pay off any past debt. And then they just have to go to the feds when they get into trouble.
Well, yes, first of all, if there's really significant reform at the state level to make demands of cities, one of the would be to be a better accounting of what the true costs of the retirement programs are, and to require cities, of course, to fund that regularly. Now, here's the irony is, because states didn't have that, cities became deeply indebted with their retirement programs. And then states like Illinois began passing laws saying, oh, now you have to contribute more. But at that point, the debt was so big that it's an incredible burden. All of the property taxes that Chicago collects, as you well know, all of those property taxes are now going to the incredible pension payments that Chicago has to make up for the past debt. And it's only going to get worse. Just this week, the National Association of Retirement Administrators put out a new report which says that once again, states and cities are being forced to reduce their long-term projections of what they're going to get in the stock market. Every time they do that, the amount of debt that they have goes up, because they're now saying we're going to get less from the stock market. And every time that happens, it's up to the taxpayers in almost every state and city to make up the difference, because there's no accounting for, there's no way, that anyone else can be asked to make up for those obligations that have already been incurred, okay, but they haven't been funded. So it's the taxpayer who makes that up. And we've just seen yet another year in which they've said that their long-term projections are going down, which means the debt is going to be even higher.
Thanks for that uplifting thought, Steve. We're moving now into the Q&A section, and to get things started, I guess we're going to, you've mentioned crowding out, Steve, and this crowding out phenomenon in the current environment where we have massive amounts of federal dollars starting to flow into the state and local governments. In theory, there are proscriptions against the federal government being used directly to, say, pay for pensions. Is that something that really actually can happen in practice, or is money fungible? Is there a way in which is this just an advertisement from the federal government that we're not bailing out the pensions?
So one of the reasons the Democratic administration, constructed a bill that said that is that I can tell you, having kind of had discussions in Washington for years about this, is that the one thing that even the Democratic Party and definitely the Republican Party really fears is the perception that they are bailing out bad pension practices in the states. Because I've had people, there are plenty, for instance, of Democratic congressmen representing states that are more or less more conservative, but their districts are still Democratic. And they are very fearful of the perception that their state's money, taxes, are going to bail out these pension systems. So that's one of the reasons they're saying that. Now, the thing is, money is fungible insofar as if the costs that they are going to be able to essentially use, and this is fairly flexible, this money. It's not just a lot of money, but fairly flexible. So they are going to be able to use this for general budget aid. Okay, what that means, right, is if it was a choice between raising salaries of the workers, right, or making a pension payment, well, in a lot of years, they would just basically raise the salaries and not make the pension payment. Nowadays, in some places, they're required to make the pension payment. The state's requiring them. But now, okay, here's what they can do. They can essentially take that money that they would have had to make the choice. Either we do this or we do that. Instead, okay, they raise salaries. Rather, they put the money in the pension system and they use essentially the money from Washington to bolster their budget, and allows them to spend money on things that they wouldn't have been able to spend money on because they had the pension payment. I'll give you an example. I'm paying attention around the country. I'm hearing cities talking about spending this money on programs to increase equity and decrease inequality in their cities. And these are very vague ideas. And I would argue that many cities don't, and governments don't even have the tools that can actually do that successfully. So they're not talking about fixing their roads and bridges and tunnels. They're talking about finding ways to end inequality. Well, good luck with that. I don't think that most inequality comes from local government programs. And I don't think local government spending is going to actually help address that particular issue. But those are the kinds of ideas that I'm seeing. I see them as very vague ideas, unproven programs, and yet that's how they're talking about using the money.
Yeah, and I actually, somebody asked me about this yesterday, and I was like, and I initially thought, oh yeah, it's good that they can't use this money to pay down their debt. But then what appears that they're using it for is to expand government.
Yes, exactly.
And to make it bigger and bigger. And so therefore, when this money goes away, I don't know if you've ever noticed, Steve, but it seems that governments can expand, but they don't seem to easily contract. So they're going to expand while they have this federal money, but then they're not going to be able to contract, and they're going to be stuck with these programs forever.
And a quick reason for that at the local level is that the vast majority of local budgets are made of people costs. In school systems, the average is 80%, but in cities, it's about 70%. In bigger cities, it's a little bit lower, but it's overwhelmingly people costs. And so when they expand these programs, they do so by hiring new people. And it's really hard to fire new people. It's harder in places in particular where the unions are very strong, because this is what they resist. And what you do is you then, in a lot of these places, the cost, because of what's happened with the pension systems and the lack of funding for retiree healthcare promises, because of that, the cost of employing the average worker in many of these cities is astronomical. In New York City, if you count the pensions, the healthcare, and the average salary, the average cost of employing a worker in New York City is $151,000 a worker. That's the average. And Bill de Blasio, during his tenure, has increased the size of the New York City workforce by 30,000. So just multiply 30,000 times 151,000, and you get a sense of the obligations that have been imposed essentially on the city.
Well, once again, everybody, we're in the Q&A section. We're getting some good questions now. I encourage all of you we got a lot of bright people in the audience. You got some bright people to ask questions of. So go ahead and dig deep and try to ask them some hard questions. We've got a few over here. I've got one more question before we get to those. And that's accounting is about numbers, but it's also about words. What are words and what's in the word? And one of the words that we're talking about today is infrastructure. What is infrastructure? Well, here's a definition from a dictionary. The basic physical and organizational structures and facilities, e.g. buildings, roads, power supplies, needed for the operation of a society or enterprise. My question is for both of you, Is this the definition that applies to the current legislation and or the development of infrastructure going forward? And does that raise any issues in your head?
Well, I'll go first. So first of all, we've been redefining infrastructure for years. If you go back to even the Obama administration infrastructure program, at the time that the cities around America sent him, if you remember, a list of 4,000 shovel-ready projects. Remember the term shovel-ready? 4,000. So I went into this, looked at them. And they were not basically, roads. I mean, there were roads, bridges, but there were things like community swimming pools, historic renovations of old city halls and railroad stations, community centers, tennis courts. And many of these were in rich communities, wealthy communities. These were not basic infrastructure. That was amenities, and that, I think, that if you look at, for instance, the Community Development Block Grant Program, which was originally created in the 1970s, essentially to help building an investment in poorer neighborhoods, it was constantly expanded in order to win approval into richer and richer neighborhoods, so that now we're essentially built tennis courts in wealthy California communities, as an example, as part of these programs. So we've been expanding the idea. I mean, people, infrastructure, you think of the national highway system, the interstate highway system. That's what we think of. That's the golden age, but that's not what we're using for anyway. So now, of course, it's gone even beyond, at least those things like tennis courts, at least they're tangible, right? They're real things. Now it's actually gone beyond that to something like providing more care for seniors through home health care. It's interesting that they put something like that as part of an infrastructure program. And the reason they do is because, in the broadest sense, I've seen surveys and written about this, infrastructure is popular among taxpayers. Partially it's popular because they think of it as roads and bridges and stuff they can see and touch. New schools, very popular, to the extent that we now build, these schools with giant, high schools with giant football stadiums and stuff like that. So, but it's popular. The fact that the Biden administration is trying to roll things like, home health care into this is, I think, an example of they understand what's popular and what's not, and they are essentially trying to fund programs for their constituency. And in this case, the home health care, the particular, the unions are very, very hot to see this area, an area of expansion of membership. And so the fact that they're rolling programs like that into infrastructure suggests, they understand what is popular and isn't popular, and now they just want to sort of sneak this stuff in and hope that while journalists and people like you and me will see that, right, the rest of the country will think it's infrastructure.
Yeah, and and the Biden administration even highlights that the bill is really, the technical name is the America's Jobs Act, not an infrastructure bill. But as you're mentioning, Steve, I think it's a sales job. In order to sell it, it's going to be infrastructure. And I think they now even have something called superstructure, where, it does include other things that, if you educate children more, provide more money to the schools, you're kind of building the foundation for a better workforce. So really that is infrastructure. I think it goes back to that term of invest, and now instead of spending, they're investing. These government terms, as you mentioned, Steve, I think they use them just to figure out a way to best sell the programs.
Can I add something too, which is, I think, very important, because the Obama infrastructure program was actually seen as a jobs stimulus. The fact that they are now transforming this infrastructure program into a jobs program is very symptomatic. That we ran a very good piece by the Harvard economist Ed Glazer. We ran it in City Journal magazine, looking at research on the Obama infrastructure program, and it failed as a jobs program. Why did it fail as a jobs program? A couple of things. Why? Okay, first of all, when they looked at where the money was spent, much of the money, many of the projects were actually in low unemployment areas. So rather than being a stimulus for those particular areas that needed this money, it went to a lot of a wealthier, because these places were more sophisticated about pitching their projects and getting them, getting them built. In addition to that, there is these infrastructure programs often come with gifts, if you will, to organized labor. And so the costs are very high. Again, this study that Ed Glazer focused on found that the average cost of a job in the Obama infrastructure program was $275,000 per job. That's an awful lot of money for stimulus. So even the idea that it's a jobs program, okay, a stimulus jobs program, the government is not very good at actually creating jobs in this particular manner. And in particular, one of the things that the Manhattan Institute has been focusing on is the incredible costs of infrastructure in the United States. We now spend, for instance, on mass transit, subway systems, rail. We spend on average 3 to 4 times what they spend in Europe or in Japan on infrastructure. How have we gotten to this particular point? It cost $2 billion a mile to build the 2nd Avenue subway in New York City. They're building subways in Germany for $500 million a mile. And as we've written, there's nothing at all in this particular infrastructure bill that actually attempts to restrain costs or in some ways to get effective use of government money. And it's really astonishing that we look at ourselves as being more entrepreneurial, less wasteful than places like Europe. But in France, in Spain, in Germany, they are building infrastructure for 1/2 what we are. And there's nothing that restrains that in this particular bill.
Steve, what was the name again of that author for that City Journal article?
Oh, Ed Glazer, the Harvard economist.
Ed Glazer, and when did that article come out?
Oh boy, I'm gonna say about 2016. I can certainly get that information for you.
I couldn't resist flagging it for everyone. Here's a question from Justin Carlson. Are cities going to wait for the passage of an infrastructure plan before deciding how to spend their CARES Act, American Rescue Plan funds? What would be the optimal use of the COVID relief funds, quote unquote funds, considering the potential of receiving separate infrastructure funding from the federal government?
Well, I mean, I can jump in here. I mean, a couple of things. One of the things that I said early on when I was analyzing even the money that was going to the states and cities, because remember, even in the Trump administration, there were several packages of money going to the cities and states. The optimal use would be for pandemic-related spending and for, I guess, what we want to call, hardening, if you will, our healthcare systems. And so that would be, first of all, to pay them for what they were spending on extra EMTs, on expanding hospitals, temporary hospitals, direct related costs. Okay. The thing is that where the Biden administration package that's being now distributed right now to, and it's essentially $350 billion to states and cities, about $130 billion is going to go to municipalities. Where that is different is it's just telling people you can use this for your budgets. And so this is why we're seeing all these stories. If you read closely, all these stories around the country, how X city plans to spend their money, how the city council plans to spend this money, as opposed to during the Trump, during those original, packages, aid packages, I'd rather call those aid packages sent to cities and states. It was specific. You need to spend them on this, on hospitals. You need to spend them on getting ready for vaccination programs. You need to spend them on you know, bolstering your EMT, your emergency services, making sure that your police department, which is now helping to respond to COVID emergencies, has enough funding to also do its other jobs. So that was kind of very direct. But right now, it's the money right now is just general budget aid, and it's being spent all over the place. All over the place. I just saw an article, this is very interesting. In Connecticut, there's a big debate. How do we spend this money? Both the state money and the municipality money. And this Connecticut economic development agency, basically out of a university, said, oh, don't spend the money on restoring our reserves and paying down our debt, because we won't get any benefit from that. Spend the money on new economic development programs. So because government has such a great track record with economic development. So this money is kind of fungible, and it's going to be spent in all different ways. And all you have to do is pay attention to the discussions around the country that are going on right now, and the stories about what city council people and mayors are thinking of using this money for. Basically, their favorite projects is one response.
Yeah, and as I mentioned before, again, I initially thought that, oh, this is good. They're not going to let them use it for their pension debt or their regular debt. But now I'm actually going, well, maybe I should have. That's better than what they're proposing to use it for.
Here's a good question from an anonymous attendee. Normally, that's where some good questions come from. Does Biden's plan include any requirements for user fees to pay for roads, bridges, ports, transit, etc.?
I'm not aware.
I don't know about.
I'm not aware of any, and I actually think we have a kind of a strange aversion in the United States. This is one of the reasons why we've done so little privatization in the United States, because typically that requires some kind of user fees, tolls, isn't it? And that's a whole other subject we can discuss at some particular point. But we have this really strange aversion. Again, I did a piece 10 years ago, a study 10 years ago on privatization around the world of transportation infrastructure. And again, we consider ourselves so much more free market than Europe, but they are doing so much more privatization. And in case of Europe, they're just basically letting private entities build, roads and bridges and then charge for them. So, but we are so opposed to this that I didn't see any in there, and that it would shock me if that kind of idea was in there.
I want to look into that now. That's a good question. Thank you, anonymous attendee. Don Nemerov is asking, relating to Steve's questions. By the way, the questions are now coming in, sadly, fast and furious, so we're not going to have enough time for all of them. But I have a question after this one, certainly for both Sheila and Steve. I want to get in. But here's Don's question. Are infrastructure costs versus other countries you were talking about, is that the result more of regulatory barriers, those cost differences, or is it really more labor or material costs?
Well, I would argue that all of those things are bound up in one. For instance, in many states use prevailing wage in order to pay workers in infrastructure projects, and that's a high cost. In some states, they don't necessarily even have to use prevailing wage, they just give the stuff away because it's taxpayers' money. I'll give you an example. I talked about those costs for subways and stuff. New York pays to build a subway tunnel. They pay the diggers, the guys who run the machinery underground. They pay them $110 an hour. Germany pays them $38 an hour or $48 an hour to do the same thing. So, and I'm not sure there's any actual regulatory reason for that. It's just what we pay because we have allowed a system where there are only a few people who do that, and we allow them essentially, we'll in New York, they will only use unionized labor, and so there's a lack of competition. So, but in some cases it is regulatory in the sense that they demand prevailing wage. For instance, I remember after Hurricane or Superstorm Sandy, in this particular region where there was all this infrastructure work that had to be done, the governor of New Jersey at the time, Chris Christie, had a huge fight to get the Democratic legislature in the state to agree that they would not use prevailing wage in this emergency. Because they were just going to do, everything was just going to have to be at the highest union rates possible. So that's one issue. The regulatory issue, the environmental issue, though, is another big issue in places like California and stuff. Even with public infrastructure, CEQA and other kinds of environmental regulations definitely add to this. Part of the issue here, the difference between us, I think, in Europe, is that we do tend to do infrastructure decentralized, and we think that's a great idea. And theoretically, it should be a great idea. But the national governments in Europe are less influenced, if you will, by the big, public sector unions and other kind of power groups. And in some states, they're heavily influenced by this. And so as a result, they are definitely distorting the marketplace in a lot of ways. And so I would say wage and labor, including regulations, including prevailing wage and environmental regulations, which, take extraordinary amounts of time. And just look at what's going on with the so-called, bullet train, high-speed train in California, which the costs are just astronomical. And the idea that we're going to build a network of high-speed trains like this, given the costs in California, that's what the Biden administration wants to do, is just, staggering.
I've got two questions here, definitely, that Sheila and Steve, we could go for an hour with you two to discuss these questions. So let's give it a try in the next few minutes. The first one, I'm going to read them together. First is by Ed Backrack. Ed's question is, it's my understanding that the New York City Charter contains provisions to keep finances in line. Are there such provisions, and how do they work? And that relates to the condition of our governments that Sheila mentioned before the pandemic. And a more specific application of that question comes from Barrett Peterson. How do we get balanced budget requirements to be governed by sustainable, gap full accrual economics and not, quote, funds? A cash balance requirement. So two related questions for you guys.
Well, why don't I take the first?
I'll start off with.
Okay.
Okay, go ahead, Steve.
No, I was going to say
you're the guest. We'll let you.
Well, let me start off with New York City, and then you can handle the second part of that question. All right. The New York City Charter is actually a very nice document, but the problems that the city has are an example of just how creative government gets. Most people don't understand this, but in New York State, they actually, the Court of Appeals, which is the Supreme Court of New York State, actually ruled, unlike most states, back in the 1990s, that municipalities and the state have to make their pension payments. Okay, you actually have to make whatever your actual, you can't fudge it. The New York City officials and state officials have been trying for 20 years to get around that, and they haven't been able to, and yet still there's all this debt. Why is there this debt? Number one is because the complexity of pension financing, the complexity of defined benefit financing means that they've been able to game the system just through essentially bad future projections. If you know how defined benefit systems are created, they have to, there are all these projections about the future. All you have to do is manipulate those projections or use them in the most optimistic way. And before you know it, you're stuck. And so New York City has been making its pension contributions, and it still has this enormous debt. In addition, there are all these new things that come up, like OPEB, retirement benefits. And New York City now has $200 billion in OPEB debt. Not only that, but every year, because they have the best possible retirement plan for healthcare, they pay everything. And not only that, but not only for you, but for your spouse with no contribution whatsoever. Because of that, they're accruing $5 billion every year in future costs. There's no obligation whatsoever to put any money towards that. That is seen as an off-balance, off the balance sheet requirement, except for the fact that when you don't have any money, you have to pay on a pay-as-you-go basis, and the pay-as-you-go cost is getting higher and higher and higher. And so the thing is that essentially municipal financing and government financing is complex enough, and it moves, it evolves fast enough so that even good documents don't do a good job of protecting people over the long term. And really, I mean, this sounds like a cliche, but the best guarantee of good government is electing good government officials, but good luck with that.
Yeah, well, now New York City and Illinois and other governments, they require it sounds great, they do require their budgets to be balanced using what us accountants call generally accepted accounting principles. But we have found that those generally accepted accounting principles, as Steve was noting, have some loopholes, and the biggest one is those retiree healthcare benefits. So under these generally accepted accounting principles at the budget level, at the fund budget level, they do not have to include their retiree healthcare costs that they're incurring. They only have to include what they're paying. So what the governments, especially New York City, is great for this. And this is why in our 75 city study, they're the worst city, is because they have to fund their pensions. So, okay, now what else can we play with? Well, we can play with these retiree healthcare. So as you mentioned, Steve, to keep the workers happy, they've just promised every possible benefit they can get. And those costs don't have to be included in the budget. And at Truth in Accounting, we're trying to clean up those accounting rules to say, no, those are costs that you're incurring, and you need to do at the budgeted fund level, you need to do full accrual economic basis accounting. You can't use this cash basis accounting that they're using is so flimsy that the IRS doesn't allow a corporation that makes more than $20 million to use it, but all these large governments are using it. And so we're trying to get those rules changed. If anybody listening wants to help us, just reach out to us. And I know Steve and Barrett Peterson and Ed Bacharach have helped us in that project, but we're welcome to have more people involved.
Well, we've been talking about infrastructure. Here's a question that's, infrastructure in the context of broader government financial conditions. Here's a question regarding the latter. This is from Joe Mathewson. So what's the solution? Is restructuring of debt through bankruptcy or related procedures something to pursue?
Well, I would start at the very basics, which is let's go ahead and really balance the budgets. Let's stop digging these holes. Don't allow the budgets to be balanced by including these games that they're playing with loans that Steve was mentioning out. Make governments pay for all their compensation costs that they're incurring, including pensions, including retiree healthcare costs. And when they say they balance the budget, they're really balancing the budget. That may require governments to cut some programs or raise taxes, but at least the citizens would be getting a truthful picture, and they would, in essence, quit digging, I guess, which would be the first step. First step, be truthful. Second step, stop digging. Steve?
Well, I mean, if you talk about very specific solutions, just number one, accounting for and requiring places, let's say, to invest, if you will, the present value of whatever their obligations are now. That would be number one. Number two is we need it's astonishing that virtually every state has restrictions on borrowing and debt, and yet we've gotten into so much trouble. And one of the things that you have to understand is that it's an evolving problem, and it needs an evolving. The states have to be, they have to evolve in their in updating essentially their systems. And so, for instance, we went through a period starting in the 70s, and it's still going on, where courts in some states, New Jersey and New York are good examples, California is another very good example, essentially let cities violate the state prescriptions against too much debt or against raising debt without asking citizens. The courts let them violate that, and it required essentially closing those loopholes. Now, some places like New Jersey, people got mad enough that what happens is they actually had a referendum to close that loophole. And after that, 80% of the people voted for that referendum, to give you an idea of how popular it was. So they did actually finally close that particular loophole. Now, even as they close it, right, people are looking for new things to borrow, like the governor of New Jersey, when the Fed opened the window during the pandemic, went to that window and asked for $4 billion. And he's like, well, this isn't actually violating, and now, this isn't violating that referendum that you guys passed a couple of years ago. So now there are court cases about that. Part of the reform has come from citizen groups, and states with citizen groups that are most active, I think, have the best shot. And so, a lot of times it's simply, the reform comes in the form of citizen referendums, and citizens are pretty, pretty good about debt. They tend to be more restrictive than most city managers or most state managers. So part of it is it is a never-ending process of reform, because no sooner do you close one loophole than someone is trying to figure out another way of another legalistic way of raising money in the same manner that they have before, but calling it something else. So, and I tell that because for a period of time, I was giving a lot of speeches in front of like citizen groups around the country. And that was the taxpayer groups that's what I mean by, and over and over again, I said that the problem is you have to be ever vigilant, because these folks are paid to do this stuff. And some way or another, taxpayers have to push back.
Yeah, and we actually gave Utah our Truth in Accounting Award one year, and I was able to present it to their budget director. And I said, you can answer this question for me, which I get a lot, is what are you guys doing right and other states are doing wrong? And she said facetiously, well, we do something very unusual here. We only provide the services and benefits that we can afford.
Yeah, right.
Well, we're about to close up. Here's a couple of related infrastructure more specific questions. Sheila had mentioned this group called Strong Towns. Among other things, they've done things like suggest that roads should be treated as liabilities, not assets. Steve, you talked about the maintenance issues. Is deferred maintenance, is that really a huge issue? Is it as big as what some?
Here's the thing. Here's the Strong Towns talks about roads, but I'm not sure why they just talk about roads. The thing is that everything that government builds, whether it's a mass transit system, whether it's a new high school, whether it's an office tower that they're going to own, or if it's new roads, everything that government builds has to be maintained. Here's the thing. You can build this stuff with debt. You have to maintain it with taxes. That's the problem. That's why we have all this deferred maintenance. And you see this around the country, and it's really astonishing. I'll give you an example. A lot of stuff that's built, when they fund it, okay, when they put out the bond offerings, they have to say how they're going to maintain it, because the bondholders are a little bit worried that if the thing, sort of falls into disrepair, particularly if it's something that's meant to generate revenues, like let's say a convention center is a good example, or a toll road, the bondholders are worried about this. So they actually have to say, what's the funding mechanism? And in many cases, the funding mechanism is a dedicated taxes. Dedicated taxes are turning into one of those scams. Years ago, I'll tell you, transportation projects, many of them, for instance, are funded with gas taxes. Years ago, New York State started paying the salaries of employees in their transportation department with the gas tax. It's supposed to be for maintenance. They redefined the employee salaries, right, as part of what the dedicated tax should pay for. Around the country, states have the taxes on your cell phone usage. Okay, there's always a little surcharge. The federal government originally allowed that because they used this federal infrastructure. They originally allowed that so that states could have money to upgrade their own cellular infrastructure, mostly for 911. All around the country, they now, because of the ever-present use of cell phones, they have way more money. They collect way more money in that than they need to upgrade their 911 infrastructures. What are they doing with that money? They're just sweeping it in to their general funds. So So essentially, in the places where they actually dedicate taxes for this, they don't even sometimes use the taxes just for that. So the fundamental principle is you build this stuff with debt, but you got to pay for it with taxes, and that becomes the problem.
Well, we're at 12:30, Steve. It's great to hear your enthusiasm and your discussion with Sheila. I'd love to go for another hour with you guys, but we got to call it a day. Thanks everybody for joining us today, and look forward to seeing you in the future. Stay safe and be well. We'll see you later.
Thanks, Steve.
Thank you. Take care, everyone.